Hey team, Ben from Pivot Wealth here, and today I'm talking about the investment and property market update from May 2022. What investors should be looking out for, what smart investors are doing, some of the hacks and trends that we're seeing in the marketplace at the moment. Now, as we're going through, please feel free. Any questions, pop them into the Q&A, and happy to cover off as many of those as we can. And guys, look, just before we jump into the content, please don't rush out and make any life-changing decisions off the back of what we cover. Strongly suggest you seek out personalized advice before jumping in. So, in terms of what's going on in markets in the news, we've seen Labor coming into power, the Labor government in Australia. Big move from an economic perspective. What that means, I suppose, time will tell. But we're already seeing some signs of some of the things that they've got planned, involvement in wage discussions, what they're doing from an inflation perspective. They seem pretty committed to doing that, which is actually probably not an ideal outcome from an investor perspective, but probably good overall for the economy. So watch this space on that one. We've seen a crypto meltdown in the last month, the Terra Luna fiasco, huge amounts of money being lost by crypto investors, probably highlighted the altcoin risks and staking risks. And I know that from some of the content that we put out before, that it is just really unclear for people what risks are actually involved with crypto staking and the different altcoins that are out there. We've been seeing a rising market for a while. So I suppose it sort of highlights the fact that there are these risks there that do exist, and people should really be aware of that before jumping into the market and be considered with their investing approach. We're seeing inflation kicking off. That was big news from the last month. The inflation data's come in 5.1%, massive highs, kicked the RBA into gear, and we're seeing interest rates increase almost immediately as a result of that. Something that I think, we're going to see more of. But yeah, it's a bit of a scary one. I'm going to talk about that a bit more in the market trends. Interest rates on the rise as a result. And what we're also seeing with interest rates rising is that mortgage borrowing is tightening up for some high risk sectors. I just put out a piece last week. We've seen that a number of the big banks have reduced down now the income caps from previously up to 9 times salary down to 7.5 times salary, which means that people are borrowing less money or able to borrow less money to get into the property market. Something that's going to have a further slowing down effect on the property market. And I'm going to go through some property market updates as we go through as well. Look, the share and property markets are in the crosshairs when it comes to collateral damage from interest rate rises from the reserve banks. Both the RBA in Australia and the Federal Reserve in the US have highlighted the fact that their inflation is their primary concern, and that they recognize that markets are coming through. Hey, Blues, welcome. Thanks for joining us. Any questions and comments, pop them in and I'll cover them off. China, hi as well. Guys, as we're going through, any questions, feel free to throw them in. So the share market and property market being collateral damage, I think that is a bit of a concern for investors, and certainly should be. We've seen the market's just continuing to run. And I think for people that have invested in the recent past, or people that have only been investing for the last few years, we're only sort of used to seeing the up. So I think now that we are seeing a bit of a wobble in the market, it means that it highlights the fact that we need to be more strategic, more considered with investment choices to make sure that you're getting the right outcomes. I'm going to talk a little bit more about that as well. One other thing that we're seeing in the last month is the China lockdowns are having a massive impact on economies and the share markets around the world. Obviously huge economy in China. The fact that they've shut down, it does sort of have that ripple effect coming through to share markets in the US in particular, being a big importer from China of services and goods, as well as around the world. So that's something that's really important and one to watch over the next little bit. Now, in terms of what we're actually seeing in the property market, so to throw some numbers at you here, over the course of May, we saw the Sydney property market has declined by 0.9%. which is increasing the decline a little bit from last month, which was 0.02 of 1%. For Melbourne went down by 0.6%, which was flat, dead flat last month at 0% growth essentially. So it didn't go backwards, but it also didn't go up. We're still though seeing, so Sydney, Melbourne is declining, but we're seeing other markets that are continuing to grow. So Gold Coast, Adelaide, and Perth, they've all grown slightly. Gold Coast at 0.8%. That's slowed from the 1.7% that we saw in April. Adelaide has grown by 1.7%, which is up from 1.9% in April. So if you think about it, really the Adelaide market and the Gold Coast markets, they've grown by almost 4% in the last couple of months, which obviously there's a lot of negative press around there about the property markets, but the fact that we're still seeing huge amounts of growth, from a dollars terms perspective in those markets. Perth has grown by 0.6%. Slightly slowed from the 1.1% that we saw the previous month. And overall, across those 5 capital cities, we've seen a decline of 0.3%, which is down from growth of 0.3% in the last month. In terms of the share markets and crypto markets, where the ASX is down by 3% in the last month, that's down now 4.69% year to date. The S&P 500, so the 500 largest companies in America, that index is down by 0.1%. Up by 0.01% in the last month, but it's still down 14% for the year to date. So it shows that there is, one, the market's gone down considerably. Two, the market in America has gone down much more than the market in Australia. And it's even more in the NASDAQ, which is the biggest tech company market in the US. That went up by 2% last month, but it's down 24% for the financial year to date. The crypto market index down 21% in the last month, not surprisingly, with all of the fiasco that we saw, and it's down 36% for the year to date so far. Welcome to the guys that have just joined in as well. Great to have you guys here. If you've got any questions about any of the stuff that I cover, feel free to pop them into the comments as we go through as well. Our investment story of the month is the Brisbane Broncos Limited. So best known for owning the rugby league team in the NRL, the Brisbane Broncos. They do the holdings and merchandising. It's funny that the Brisbane Broncos have been performing well on the field over the last little bit, and the share price has been rising along with it. So the year-to-date gain on Brisbane Broncos, which is BBL on the ASX, is 39.29% for this current year. So it's getting some serious growth. Who knows what will happen if they keep their place in the top 8 and make it through to the finals. In terms of things to keep an eye on in the markets over the next little bit, we're seeing this tech slowdown. This is real. As I said, the NASDAQ index is down 24% for the year to date. So a big one to watch over the next little bit. Particularly, we talk to a lot of people that are working for technology companies, and these guys have seen their share prices battered really hard over the last little bit, which when you're used to getting, shares given to you and them just constantly rising over time, it is something that you need to really, keep a close eye on and a bit of a risk to manage in your overall wealth building strategy. Rates are on the rise, interest rates are on the rise, and that's going to continue to flow through to markets. So yeah, one to definitely keep aware of. Is going to lead to probably some opportunities in the property market with things slowing down, and it's almost a slowdown that needed to happen with the property market having risen so much in the last little bit. Inflation data, I think, will be critical over the next little bit. So what happens to inflation, how quickly it starts to wind down from the highs that we've been seeing. And overall, I would say that buying opportunities have been are definitely there when it comes to pockets tech. There's some interesting opportunities there. Property is the same. Just got a comment from Damien saying, yeah, I work for Spotify and the price been hammered over the last 18 months. You're certainly not alone with that, Damien. We've got some real horror stories over the last little bit. it does really highlight, though, the importance of having a really considered strategy around your employer share plans, because we've seen people that have gone from having solid 7 figures in their share plans. And when you're inside a tech company or any company really, that you see that, you believe in the company, you see it growing, and it seems really positive. You think that it will just continue to grow. And certainly that's what we've seen in the last little bit. But when when we're in the market that we're in today, that you're getting hammered, those tax bills just keep a coming. So you need to have a clear plan around that as well. Hey, Sleeping Tiger, welcome. Great to have you guys here. Saja, guys, any questions as you come through, feel free to pop them into the comments. Get John, welcome. BMW, g'day. So, in terms of some of the economic data that we're seeing, there's some pretty interesting stuff there that, for maybe for a money nerd like me, but things that flow through, I think, to all investors. That inflation numbers are up 5.1%. That's up from 3.5% in the previous reporting period. Household savings rate is at 13%. That's 13.6%. That's pretty steady. Economic growth 4.2%. So that's still ticking up from the previous month, which is at 3.9%. Unemployment is at 4%, so that's going down from the previous month, 4.2%. Employment growth is at 2.6%. So employment jobs are still growing, interestingly. Unemployment down, and the economy still one positive thing is the China growth rate has increased in the last month to 4.8% from previous 4%, which makes a big impact. And the AUD USD exchange rate, the Aussie dollar is now buying 69 US cents, which is down from 0.72% from last month. So if you've got US shares, potentially you're getting more Aussie dollars for them now, potentially a good time to do that. Got a question here. Not sure if this is a serious one or not, but what car should I use for a trick? Well, given that your handle is the silver BMW, I would say that probably the best one is a silver BMW. Not sure if that's a money question or not, though, but I hope that helps. US economic data, we have seen inflation over there, 6.3%, which is still increasing from 6.1% in the previous period. Their economic growth is at 1.2%, which is down from 7%. So big slowdown happening in the US. That's really important because the US market has a flow-on impact to all markets all around the world. So it's a really important one for investors. Their unemployment rate is pretty steady over there. Household savings rates, interestingly, are below the pre-COVID level, and home sales and the property market over there are declining there. Question from Sleeping Tiger: how do you educate your clients about investing in your crypto? I think you mean just investing in crypto. We don't have any specific crypto that we advocate or produce or anything like that. But I would say that crypto is something that's really increasingly impossible to ignore when it comes to investing. And personally, I got a little bit of crypto. I think it's got a good long-term potential. When we're tackling that around investing and planning with clients, we factor it into their overall plan. So it's a really great question, and thank you for that. But it's like, what is it that you're trying to achieve? What are the inputs that we're working with? And then making sure that any investments are consistent with that. So that includes shares, it includes property, it includes crypto and digital asset investments as well. So essentially just want to understand those characteristics, how they fit, and what the play is there. What I would say, though, in terms of practically, is that one of the things that I've found to be really important when it comes to any sorts of investing is that you want to be setting a solid foundation of your investment plan first. So you want to have some probably more sort of consistent sort of boring investments that are just going to give you reliable, consistent progress over time. And as you build those up, then having more that are in the more speculative, potentially sort of higher risk, higher return type investments, that can mean that that even if those don't work well or don't work well for a long period of time. Thanks for that, Pastel. Feel like we're on the same page there. Really appreciate it. Nice one. you know that if you're investing in those speculative investments, that if they don't perform for a while, or if they perform poorly, or if worst case they all go to naught, that at least you've got the basis of your investments in place, so that you can sleep well at night, knowing that your money is doing what it needs to be doing. So yeah, appreciate that, Pastel Legend. Guys, in terms of some of the trends that we're seeing at the moment, or some of the things that we've noticed over the last little bit, the first one is investor regrets based on the actions taken or not taken throughout the course of 2021. Now, we've worked with a lot of people that I think, when you're in a strong financial position, that you sometimes end up in a place where you don't need to put yourself under a lot of pressure. And so it's easy to fall into the trap of thinking that you don't really need to do anything. Now, this is where, for clients where they've been in a position where they potentially had some equity in a property or some spare cash that they could have invested, see the market sort of going up, don't have any sense of urgency. And as a result, they end up just sort of plodding along. And where it particularly worked was for those clients that were in a position where they could have bought property if they wanted to, but they didn't. And because they didn't want to prioritize it, didn't want to put in the time. And I get that it is a time input with some of this stuff, but as a result, they missed out on a pretty significant amount of upside. Now, a lot of these people are going to be fine anyway financially, but they're sort of regretting the fact that they didn't take that action at the time when they could have or should have. So that's a thing that I think we can learn from. Another thing that I'm seeing at the moment is I'm talking to a lot of people that are aiming to buy the dip, might be in property or in the share market. I think on both of those sides, that there's obviously a lot of media noise out there at the moment where people going, oh, the property market's going down, the share market's going to keep going down. And people are not investing when they know that they want to invest, but they're waiting to find this magical sort of dip thing that happens. And really, like, we never know what the dip is until after it's passed. So look, I think, if you're waiting if you know that you need to invest, the best time is always 10 years ago. The second best time is now. So, and if you wait until you're trying to find the bottom, you're probably going to find that the market would have moved and you probably missed the opportunity before you know it. And then you're regretting things. Smart investors, though, in different markets are essentially getting almost 2-for-1 deals, with some assets being pretty depressed. Crypto is one of those spaces as well. Crypto is one of those spaces as well, but where people are essentially getting 2 times the amount of investments that they would have got, a few months ago. So I think if you're smart now, Buffett has that saying, when it's raining, you want to be carrying a bathtub, not a thimble. So be confident to pull the trigger. But in order to do that, you want to make sure that you've got your I's dotted and your T's crossed so that you're not running into trouble. There is a lot of fear, though. Another trend that we're seeing is fear around taking advantage in these market conditions. So, not knowing how things are going to play out does lead to a lot of fear, and you don't want to do something dumb that's going to cost you a bunch of money. So I think that, the key to getting around that is having a solid plan whereby that you've got all your bases covered, and you're not going to be running into trouble. Will's just made a comment, say crypto is largely speculative, though. Look, Will, I would tend to agree with you. I think that it's higher risk, higher potential reward type investments. I do believe in the technology, and I think that 5 years from now, 10 years from now, we'll continue to see that. But I would put it in the higher risk, higher reward bucket. I know for me, I've got some Bitcoin. That's the only crypto the assets that I've got at this point. The only other one that I would really buy is Ether. But like, I've seen it, I saw it go up to 90,000. Now it's down at 40,000 AUD, that is. And I've never sold it. I've just bought and never sold. And, maybe I never will until well into the future. And, that means that you can ride that wave. And that's what I mean when it's like, get your foundations of your portfolio set first. Then with the speculative stuff, you can ride the wave knowing that it's not going to stop you from doing anything else. So hope that helps, Will. Guys, in terms of some of the hacks and mistakes, things to look out for, I'll start with a client story, which I think is useful to unpack because people don't talk about the ins and outs of their money. what other people have done so that you can learn from them. So this is a couple we were working with just recently. They were business owners, late 30s. Income was around $300,000. Their assets and investments, which are made up largely of cash that had been profits from business over a period that's been quite good for business, about $2.3 million. They were only saving around $5,000 per annum. They weren't doing any real tax planning or investing. They found their money management overwhelming, and there was no real clarity on why they were doing what they were doing, why they were pushing. What they wanted was some investing momentum. And when we went through the planning process, what they ended up choosing to do was do an investment property purchase, tax planning around their business, plus doing some regular, some one-off and regular share type investing. They built a clear pathway to build a passive investment income of $100,000 annually. And one of the other big benefits was that they ended up maximizing their potential, but doing it in a way where they weren't putting themselves under too much pressure. The end result, so the upside that they received as a result of making those moves, was $64,000 in year one, and over by the end of year 20, they were better off to the tune of $6 million. So a pretty huge impact from just making some relatively minor tweaks, but also giving them the confidence that they had, that they were doing the right things with a bunch of ideas that they'd already thought about doing, buying property, buying shares. We did get pretty strategic around the tax stuff that they potentially really hadn't considered, but put confidence to pull the trigger, and you see the potential upside as a result of that. So hopefully you can learn a little bit from that story. Our client problem of the month, and I alluded to this one before, but is large tax bills from a declining employee share plan. So it works a lot of companies, shares RSU plans. The shares vest and they create a tax liability for you at a share price. When the share price is declining, it means that you owe tax up here, but then the shares, the value is much lower, and as a result, you're not really left with much after you cover your tax bill. Super stressful and really annoying. So it highlights the fact that a lot of these people, they regret not having a clear plan around selling down and diversifying out of their employer share plans when they could have. When the markets are going really well, it's really easy to just keep on keeping on and think that everything's going to keep going up and up, but it doesn't always happen like that. So being smart can give you a lot more peace of mind and more dollars in your bank account. Our client mistake of the month was misgrowth from not taking the advantage of the opportunity to invest. This is one particular client that was in a strong position, a lot of equity in their property, spoke about buying an investment property. They are going to buy an investment property, but they just didn't do it over the course of the last year when they could have, because they had some personal stuff going on, didn't want to give it the focus, and now they're kicking themselves from not taking action sooner. So I think, you want to take those advantages when they come up and when they make sense. We never know what's going to happen in the market, and clearly the property run has been sort of abnormal. But you want to make hay while the sun shines and feel like that you're maximizing your financial potential. The money hack of the month is investing blue chip. And I wanted to put this up because it highlights, I think, with what's going on in the share market and the cryptocurrency markets in particular, that when you invest in the bigger companies, they tend to ride out these downturns much better than the smaller companies, smaller crypto assets. And we're seeing a lot of investor pain at the moment from those more speculative investors that had experienced really, really big runs over the last little while. But then when the markets turn, they ended up paying the price. So, really highlights that investing blue chip gives you a lot of peace of mind, and means that you can ride out these waves without having to stress it or seeing your money evaporate overnight. Success story of the month is 2021 property wins. We worked with a number of clients over the last little bit that bought properties last year. We're coming up for their annual renewals, seeing the amount of money that they made from holding their line when a lot of people were talking a lot of smack about the property market. Really big wins there as well. Guys, I hope you found that helpful. Those are my updates. Any questions or comments, you feel free to let us know. Otherwise, team, I will catch you on the